Should be good.
Right, excellent, thanks. So I have some questions for you, Miss Lindsay, that I'm getting from a lot of my clients these days. What is an interest rate buy down? Who can use it? Like, how does it apply? Can anyone use it? Like, there's just so many questions around this. Um, so I was hoping you would be able to quickly answer that for me in a little bit here. But first, for those of you who don't know, this is Lindsay Labonte from Applied Mortgage, and I'm Meghan McCormick, a local real estate agent with William Pitt Sotheby's International Realty. And Lindsay's gonna give us the lowdown on what interest rate buy downs are and
Awesome. The lowdown on the buy down. That's perfect. So when you're buying a house, especially right now, people are thinking like, what can I do to get a little bit of a lower interest rate? And I was actually just talking to some customers who had bought in the 80s, and they're like, first thing right off the bat, we don't care about the rate. It's lower than it was when we first bought. It doesn't matter. So I thought that was a great
13%.
perspective. Yeah, exactly. Yeah. So if you're not feeling like that and you're kind of like, okay, these 6s, 7s, 8s that we've been seeing recently are a little scary, there are a couple of options. So what you're going to hear about most commonly to buy your interest rate down, there's either a permanent buy down, which means you're buying the interest rate down, you're getting a lower interest rate for the entire term of the loan, or there's what's called a temporary buy down, which means what it sounds, you're only getting a lower rate temporarily for the first year or maybe the first 2 years. So those are there's actually two categories. Sometimes people don't even realize that. Permanent buy down, you're getting a lower rate for the rest of the loan. Temporary buy down, it's just temporary. So then the next question is, what does buy down actually mean? Who's doing this buy down? It's kind of like when people talk about being self-employed and you just write it off, right? Like, this is real money. So where's it coming from? So you hear people talk about paying points. So 1 point means 1% of the loan amount. It's a cost that's actually paid at the closing to potentially get a lower interest rate one way or another. And I can actually share my screen if you don't mind. I usually hate screen share on Zoom because I don't want it to be super boring, but I think seeing the math actually does help.
I need visuals.
Yeah, so here's some visuals for you. So this is like a normal, let's call it a normal purchase. And if you're just listening in, by the way, instead of watching the video, I'll try to go through the numbers. So if you're buying a house for like 500,000, let's say 20% down, these are made up, by the way, disclaimer, I'm not actually giving a mortgage or quoting a rate. Okay. This is just for illustrative purposes. So let's say the 30-year fixed is 6,875 and that your total payment with taxes and insurance is at about 3,300 a month. Okay. So if you're a really good visual, you can see it. If you're listening, remember that 3,300 a month. So this is without doing any type of rate buy down or paying extra costs or anything to get the interest rate. It's just the no points rate as it is.
Straightforward,
clear as mud. So if you wanted to do a permanent buy down, which means you get a lower rate for the entire term of the loan, this chart I'm showing now, it's the first column is what we just went over. So like 3,300 a month. The second column is paying 1 point. So 1 point means 1% of the loan amount extra closing costs paid at the closing. So if your loan amount in this case is 400,000, 1 point means $4,000 extra that you're paying at the closing to then get, in this case, a 6.375 interest rate instead of 6.875.
Okay.
So you're saving about $130 a month. Your payment goes down from about $1,330 to about $3,200 a month. So you're paying $4,000 extra because you're paying that 1 point to save $132 a month. So the question is like, does that make sense, right? Sure. And you can look at it in a few different ways, but if you're thinking you're paying $4,000 extra up front to save $130 a month, that's going to break even in 30 months. So like a year, 2.5 years, let's say. So it's kind of a gamble, like short run, long run, as far as what actually makes sense for you. We can get into more of those details based on your scenario, but that's just the math of it. And then people say, well, how many points can we buy if we really want to get a lower rate? Usually it's 2. So our last column here, we have those 2 points, which is $8,000 in that case, saves you about $200 a month. The break even is actually a little bit longer. It's about 3.5 years. So you can kind of see there's usually sort of a sweet spot. Oftentimes it really doesn't make sense to pay more than a point because that break even is going to shift.
Sure.
But that's the general gist of a permanent buy down. So you're getting that lower rate for the lifetime, in that case, the 30 years.
Sure.
So the other option, which is kind of what's buzzing around as more of a newer option now, is a temporary buy down. So this gets
new in the industry, or just?
It's not new in the industry. Actually, it's kind of old in the industry, and then it came back.
Okay. Everything makes a comeback.
Yeah, exactly. So what's most common right now is a seller paid buy down. And what that means is that when you negotiate your offer, if the seller's willing to give you some credit back toward your closing costs, you can use it in a variety of different ways. This example is to use it to temporarily buy down your interest rate. And so what this is showing you is we had our first column, which is just the regular 30-year fixed, no points, everything. But this is a different loan program. So you'll notice the rate, the starting rate, the 7.125 instead of the 6.875. So for this program, you're going to end up potentially with a little bit of a higher rate in the long run. But in the short run, you're temporarily buying down the interest rate. So if you hear a 2-1 buy down, that means you're buying down the rate by 2% in the first year, and then by 1% in the second year. And then the third year on, which is our third column here, it goes back to the 7.25 or 7 1/8 rate for the rest of the term of the loan. So people are opting for this because they're gambling. They're hoping that rates will come down within the next 2 years and they'll refinance into a lower rate at that point. So the cost of the seller actually paying this buy down for you. So you can see during year 1, you're getting it down 2%. So to 5 1/8, you're saving $527 a month. That's huge for the first year. Then the second year, it's a 2-1 buy down. So it only goes down 1%. So it's 6.125. You're still saving $269 a month. So the seller's actually paying the difference in those payments for you. So it's literally just $527 a month for 12 months and then $269 a month for 12 months. Add it together. The cost of the buy down in this case is $9,563. So you might have noticed in the beginning, why did our purchase price go from 500 to 510 on this chart? Well, it's because you might have to offer 510 to get the seller to actually credit you back the $10,000 to complete the buy.
Yep.
That's where your realtor comes in. So that's beyond my pay grade. So
that's good, because the other stuff was way beyond my pay grade. Because I'm like, good thing we have experts in the industry, because I got nothing.
Yeah, so that's the math. That's the brief overview. Of course, depending on your situation, we would talk through, here's the different options, what makes the most sense. With the the permanent buy down that we went over in the beginning, you can pay that extra cost. The seller could pay that extra cost, right? So it can come from either. The temporary buy down for the programs that we have has to be paid by the seller. So that includes more negotiating on the seller side of things. Sometimes buyers say, like, well, why can't we just pay our own buy down? It wouldn't make sense because you would literally be paying upfront what you would be saving, right? So that's why it's got to come from the seller for it to work out.
So
hope it's helpful.
It is. The long term, the permanent one, can anyone do that? Or does that fall into certain situations?
Yeah, great question. So for the permanent buy down, where you can buy down the rate for the whole loan, that's actually any loan product. You can always talk to your lender. I'm saying always, there should always be an asterisk next to always. But yeah, talk to your lender. Usually that's something you can do anytime.
Yeah.
Yep. Whereas the temporary buy down, the 2-1, that is a conventional program that we have right now. So that would be for conventional buyers that would be eligible for that program.
All right.
Awesome.
That clears it up a little bit. Thank you.
Clear as mud. And I think the question for the for you as a real estate professional too is you asked a little bit about how did the temporary buy down kind of come back into play. And I think that in some areas there are houses that might be sitting on the market for a little bit longer, even though this is such a seller's market. Once in a while you're going to get something that was just funky, something about it, priced wrong, whatever. And so rather than offering the seller a significantly reduced price, the idea is maybe you do go in at the asking price, but you ask them for that credit back, and then they do that temporary buy down for you. And then you as the buyer are saving, in that case, the $500 or whatever it ends up being initially per month.
So you do need to be a little bit creative in this market. One, like you said, it's a seller's market. There's so much going on. There's the interest rate is scary to people. So it's good to know that there are options that make them feel less panicky after coming off, 3% mortgage rates.
Totally.
2%.
Tools in the tool belt. You could get a 5 in front of your rate in that case. So it feels better for that first year at least. You just want to make sure you understand that after the first year and the second year, it goes to potentially the higher rate. Yeah. Unless you can refinance. Everyone's hoping for that. We'd all be very happy.
We're hoping that the year of the 5 is kicked down the road a little bit and it actually comes about. But thank you so much.
That's a whole other conversation.
Another day. But thanks so much for jumping on and giving an explanation on that. And
thank you.
Yeah, I look forward to the next one.
Thanks for having me.
All right. I'll talk to you soon.